Hey everyone, today we're talking about becoming clutch life insurance. My name is Isaiah Goodman, Chief Financial Advocate at Becoming Financial. Again, it's right around Halloween, and this is one of the things we never really actually like to talk about, death and dying. Now, with Halloween, we kind of joke around, witches and skeletons and ghosts and all that stuff, but we never really talk about things that really matter, like life insurance. So we want to take some time around this holiday that we kind of joke about death and get real for a second. One of the biggest issues that people think about when it comes to life insurance is that it's going to cost too much. They're afraid that it's going to be hundreds of dollars per month. They can't afford it, so we just never look into it. What I found is that that's a big misconception. So what I want to talk about today is the different types of life insurance, how they work, some general sort of costs, and how you might be able to become clutch for your family in case something happens. So first of all, where does life insurance actually come from? It actually originated with monks. So monks at monasteries would try to take care of each other's families if something happened to another monk. So they started to figure out if we pool some of our monies that we've got, we don't have to use any of it until something happens, and then we can take care of the estate of the one who passed away. So that practice originated with monks and has kind of been passed down through the years. There's a ton of different insurance companies in the US, thousands and thousands across the world. Some of them have different philosophies, whether they're publicly traded or private or mutually held, where the people who own the policies are essentially owners of the company. But one of the biggest things, the most important, is this. You put in money, that money is then pooled together and invested in a way that they can get some gains and returns. Then they take from that big pile of money and pay out the claims when something happens to one of the policy owners. So that's how life insurance works. That's it in a nutshell. Almost all insurance should work the same way, whether it's auto insurance, home insurance, disability, long-term care, anything. They're taking all of the claims, sort of divvying out all the money that's been collected from all of the policy owners. In life insurance, the payout doesn't come until the person who's covered actually passes away. So that's how it works. So pros and cons of that, obviously, number one, if you're paying for life insurance and you don't pass away, you got to keep paying for it. That's hopefully objective number one, though, right, is to live a long time. So there are a couple different types. Some life insurance, like term insurance, can actually go away. So if you've paid for term life insurance and didn't pass away, you don't get anything back. So that can be a negative. Another negative is some of the other types of life insurance, like whole life or permanent, can be kind of expensive. So that's where some of that frustration can come in. If you want to have a policy for a long time and it costs $300, $400, $500 a month, it might be a little bit prohibitive. So those are some drawbacks. But in my opinion, the pros far outweigh the cons. So something like providing for your family if you're not here, that's way more of a benefit to me and my family. And it just provides some assurance in case something happens. So I'm willing to sacrifice a little bit of our income to take care of my family in case I'm not here. So next, I wanted to talk about some of the different types. First is what's called a non-variable. So essentially this means either the policy benefit amount isn't going to change or the payment isn't going to change. So there's a couple types. The first one's called annual renewable term life insurance. So term life insurance, you might hear about it talked about all the time. Generally annually renewable, starts really cheap based on your age and health, and it might actually cost more each year as you age. So as you age, it costs more and more and more. The reason being, they renew that contract annually with each year of age. So that's a really basic one. And you hold that one for 10, 20, maybe 50 years, depending on the life of the contract. Another one, probably the most common type of life insurance, is called level term life insurance. You can buy these policies in any number of years, 5, 10, 15, 20. Some companies are starting to offer 40-year term policies. So you essentially trade in a set premium, same amount every month or quarter or year, however you want to pay, and they'll give you a same amount of coverage for that entire duration. So what this is kind of like, it's almost like renting your coverage. So in exchange for that roof over your head, you'll pay this rent amount. If you pass away, your family gets the coverage. If you don't pass away at the end, you sort of get evicted or you decide to leave the apartment, you don't get anything back. So that's the essential basics of term life insurance. It's a way to provide for your family, make sure you're taken care of. Now, I've seen coverage anywhere from $10 a month for $100,000 for a young, healthy person, up to a couple $100 a month for a couple $1 million policy. So it depends on what you need, your age, your health. Those are some of the factors that go into it. The younger you are, the healthier you are, the less coverage, really cheap, maybe 10, 15, 20 bucks a month for a couple $100,000 of death benefit. If you're 50, 60 years old, maybe you've had a history of things like diabetes or heart disease, and you need $2 million of coverage, it's going to be pretty expensive. So something to keep in mind is, of course, apply as early as you can. It's not just a sales gimmick from insurance salesmen. We're not saying that you need to buy today because we need to get paid, but it's because you probably need to get the coverage as soon as possible to save some money and protect your family, to come up clutch. The other type of non-variable type of insurance, life insurance, is called whole life or permanent life insurance. There's a couple different names for it. You might hear different people like Dave Ramsey, Susie Orman say it's bad, buy term, invest the difference. Well, there's a couple things there. Number one, some people might not invest the difference. So if you can get a term policy for the same amount as a whole and invest some of the difference, say you get a term policy for $10, the whole life would have been $100. Well, you get the term, invest the 90, right? Most people don't follow through. So that's something to consider. The other big thing too is what will happen once the term policy is done. If you haven't accumulated enough in terms of assets, what are you going to leave for your family? So some people really like whole life. It does cost more. Sometimes it's a little bit tougher scrutiny to get, but once you're approved for whole life, they lock in the price. You pay that for a set number of years, and then the policy is yours. So this can be kind of like owning a home. So if you own a home, you pay a mortgage for 30 years or whatever, then it's yours. You get to keep the equity inside the home. So some policies actually cover or allow for cash value to build up inside the plan. So that's, again, another option for you. Typically non-variable because the premium doesn't change. The death benefit might generally grow as the cash value grows, but it's not going to be based on any sort of market conditions. It's going to be the returns and the performance of the insurance company. Last thing, variable. And there are a ton of different types of variable life insurance plans. Universal, variable universal, all of these types of things. The basics is this. You can invest in a type of a plan and you can call it investing because a lot of times it's actually tied to market returns. So if you're putting $100 a month, you might get X amount of death benefit, and then the cash value on the inside can vary, variable, based on the returns of the stock market or whatever the company is investing in. So that can be something that might be a little bit greater returns in the long term than like a traditional whole life plan, but it could also lose value. If the stock market bottoms out, you might lose that cash value or the value inside the plan. And sometimes if it loses too much value, you have to pay extra premiums to catch up. So there's some pros and cons to variable plans, but again, with all of these, it's based on your situation. If you've got a tight budget but want to protect your family, term life insurance. If you've got a little bit more leeway and want market returns, variable. If you've got some money in the budget and you just want to make sure that it's there forever, slow whole life insurance might make sense. So hopefully that clears up a little bit about how all this stuff works. Again, I know it's Halloween and we kind of joke about death and dying and ghosts and stuff, but make sure you get some coverage for yourself, for your family, your loved ones. Make sure you get some life insurance to take care of people so you can come up clutch.